It is amazing the number of people I see talk about how to recession-proof your portfolio. So what does that mean exactly? Well, a year and a half ago, we talked about markets being overpriced. There's probably going to be some sort of recession. It can't go on forever. We would never make a date because that's just guessing. Now, all of a sudden, everybody said we were crazy. Now, all of a sudden, 98% of CEOs or some BS like that are saying we're either in one or upcoming, and like 80% of investors out there think we're either in one or it's coming. So, how do you recession-proof your portfolio? So, what does that mean exactly? Well, it means as a recession comes, earnings drop, revenue drops, very volatile companies will get hit more. We've seen this recently because of ARK. Look at ARK. Now, I do think ARK was just ridiculous in their assumptions. But look at this entire fund. It is up 4.5% over the last 5 years. It was as high as 160 a share. It's currently at 36. This is a company that was betting on innovation. But guess what? You can overpay for innovation. You can overpay for a wonderful thing. You can overpay for pretty much everything that people like is overpaid for. Because remember, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. What does that mean? Ben Graham said this early on in the Intelligent Investor or Security Analysis. It means in the short run, whatever's the most popular is going to go up. Whatever's the least popular is going to go down. But in the long run, the weighing machine means what are the fundamentals of the business? What's behind it? That's going to drive the value. If you have a company that makes $100,000 a year today, in 10 years, if it makes $500,000 a year, in all likelihood, as long as you paid a reasonable price for it today, your value has gone up 5 times. That is the basic general idea. So in a recession, what do we have? Well, we have decrease in profit margins, decrease in profit. People get scared. They start to sell things, right? We've seen that this year. What's the NASDAQ done this year? It's down 30-some%. The S&P is down over 20%, both in bear market territory. That's scary. But people are saying, oh, don't worry, we're fine. Everything will be okay. My first statement, we are nowhere close to done with this bear market. It very well could have a nice rebound, but by the time this bear market is over, stocks will fall a lot more. Does that mean you should go sell stocks? Absolutely not. What that means is use this as an opportunity to see what companies you own that are great, what companies that you paid a reasonable price for. Don't follow hype. When you're buying a stock, you're buying a piece of a business. If you don't understand that, take all your money and put it into a long-term ETF and just dollar cost average. Why? Because as you know, in the long run, this is where stock prices go, but this is how they get there. And during booming times, they're here, and during recessions, they fall to here. But guess what? These are the best times to buy. Look at the history of stocks. Go back to 1900. When things looked the worst was when stocks were at their worst. And what ended up happening? Things got better because nothing is ever as good as it seems, and nothing's ever as bad as it seems. And we always get better as a country. If you believe in the US, you should believe in the long-term prospects of the economy and the stock market. However, it doesn't mean overpaying will mean you get great returns. What it means is you should dollar cost average through good times and bad, and sometimes you'll overpay and sometimes you'll underpay. But over the long run, this is what you'll pay. And if you buy a low-cost ETF that costs very, very little, you'll basically match the market, which will beat over 90% of actively managed Harvard MBA run mutual funds out there. Don't waste your money paying all those fees for getting subpar returns. Okay, but if you're the kind of investor who wants to make a few picks on your own, you need to understand the process of buying stocks. And here is my spoiler alert. How do you buy stocks during a recession? How do you recession-proof your portfolio? You should never recession-proof your portfolio. I repeat, you should never recession-proof your portfolio. You should always buy good companies, great companies at good prices. And when stocks fall, you buy more of it. What does a good price mean? It means that with using something like our stock analyzer tool, where you can sit there and put a company in a stock, let's say, for example, Microsoft. You look at Microsoft, you make your assumptions for the future, and when you input it in there, if it says the stock is overpriced, you don't buy it. And when it's underpriced, you buy it. Because remember, you're not going to be able to buy the bottom. And just because you're a value buyer doesn't mean stocks are going to go up from there. Because the overall market is still, if stocks go down another 30%, every single one of my stocks are going to be down. Every single one. And that's okay, because if I bought good companies at good prices, I should be happy about that to be able to buy more of them at lower prices. So a company like Microsoft, which is currently at 235, and let's look at their history. They had a high in the last year of 350, got as low as 220 in the last few days. This is a company that's going down along with the market. Why? Because it was overpriced. Let's look at the 8 pillars of Microsoft. We love it. Every metric we love except for PE and price of free cash flow. It just says we need the price to come down. But when the price comes down, what else has changed in the company? How can a company be so overhyped to get to 350 and just months later be worth 220 and it's probably on its way down even lower? That doesn't even make sense to me. If you buy companies based on cash flow, you pick the price that makes sense to you and you buy it as it goes down. And during a recession, it gives you an opportunity to buy the best names at better prices. So if you loved Microsoft at 300, why would you not love Microsoft at 220? If you don't want it at 220, it means you didn't really have a process. And that's understandable. I was in your exact same shoes. I used to love companies and say, hey, I'm a value investor. I love it when stocks go down. Then my stocks would go down. I'd say, oh boy. And guess what? Still part of me does that. When stocks that I buy have gone down, I still wonder, okay, am I making the right decision here? It sucks to see your stocks go down. Absolutely. And it's going to go down for everybody. Look at Warren Buffett. Watch Berkshire Hathaway. They will have, when this market's all said and done, their portfolio will be a lot lower. They will have losses on their stocks, but that's okay. He was going to use an opportunity to buy more of those companies. He's been buying Apple, I think, below 140. Where's Apple currently? Apple's currently at 141. If Apple got to 100, Warren Buffett would be buying a ton of the company. He would love it. He'd say, great, I get to buy a better company at a better price. That's the way you need to be about investing. You don't recession-proof your portfolio, you foolproof your portfolio over long periods of time. But you have to have the ability to wear through that. You have to have the ability to sit there and say, the markets will get better. This is the S&P. I'm just going to pull up SPY. The S&P, this is the S&P since 1993. Look at this. Tech crash and 9/11. Then 9/11 right there. Financial crisis. COVID. Look at all this stuff, guys. Stocks will go up as the U.S. economy gets better. So how do you buy great companies at good prices? Very simple. Watch a lot of our videos. We have over 1,800 videos, and the great ones are a year and a half ago when all the keyboard warriors were telling us how stupid we were for not understanding Peloton, Palantir, Workhorse, Nikola, and all these crazy stocks that are down 70, 80, 90%. And trust me, like I said, I still have stocks that are down. The difference is when my stocks are down, I go, great. This is a buying opportunity because they make sense at this price. Those other ones had to have everything go well for them to make sense. So let's look at Microsoft and how you use our software to make better decisions. So like I said, we had our 8-pillar portfolio here. This tells me high return on invested capital, revenue growth, net income growth, reasonable debt, buying back shares, and great cash flow increase. But the price is too high. So I'm going to look at the analyst estimates. Our data feeds pull in analyst estimates for every company up to 5 years. Earnings per share, $9.48 this year. They're expected to do $20 in 5 years. So they're going to double their earnings per share according to the analysts that are following the company that we get a data feed on. Go to the revenue. Revenue is $200 billion. They're expected to do $375. So good, strong, low double-digit growth. So how do you use that to your advantage? Well, that's the stock analyzer tool here. This is the most important, the most popular part of our site. People go in here. I get screenshots in our community all the time. Paul, what do you think of my assumptions, etc.? Remember, every investment is the present value of all future cash flow, but we don't know the future. We have to make assumptions about that. Those assumptions are, the goal is to be very conservative. That way you can buy when the stock is lower than the assumptions. So let's use Microsoft as an example. The revenue growth was low double digits. I'm going to put that as my high side. 10%, because I'm going out 10 years, not 5 years. And they're analysts, and they tend to be more optimistic. Middle, I'm going to go 7%, low side 4%. Profit margin. And their profit margin has been increasing in the last 10 years. So I'm going to do 28, 31, and 34%. Free cash flow margin. I'm going to do the exact same thing. Now, PE, guys, high return on invested capital, good growth rate. And such a very strong moat. I mean, Microsoft owns the Microsoft Office suite. They do so well for everything. Everybody uses Microsoft in some way, shape, or form. Even the Apple haters use Microsoft. So I still have to put a reasonable PE here. Now, this is going to deviate from the past. I'm going to go 14, 16, and 18 because I do believe they deserve that kind of multiple for earnings and free cash flow. Our final metric, though, is its input, desired annual return. What return do you want for owning this company for putting margin of safety in here? Okay, you can get 9 or 10% from a long-term ETF. So you need a higher rate, and the more aggressive your assumptions are, the higher desired return should be. So, company like Microsoft, I'm gonna do 12, I'm gonna do 13.5, and I'm gonna do 15% on the high side. I'm gonna hit the analyze button. Now, guys, the stock is currently at 236. What do you do if all the 6 numbers that show up below are all green? Do you go out and buy? No. Go out and verify that all you did here was correct. Go do your research. How do you do that? Guys, the best and easiest way is joining our community. We have thousands of people in here that are like-minded value investors who want to learn and want to learn from each other. Research is hard. Research is time-consuming. So go do it with other people. Don't take their bias in there. Look at the facts. Split it up. People in here have done, they're like, hey, what have you seen about this company? What do you see about this company? What do you think about Microsoft? Go do those things. On our software, we even have access to the annual reports, the 10K. You click that button, go to 10K, boom. Your 10K just popped up in a matter of seconds. These are the things we are doing for our company, for our software to make it better and better. I use this software every single day. I look at companies I add into my watch list. I have 99 companies on my watch list currently. This means that when these companies hit the prices I set them for, I'm gonna get an email and I'm gonna get a text message on my app and a message on my desktop telling me, Paul, X company hit X price. Now, I set personally my watch list price to the price I want to do more research and then start selling puts starting at those below levels. They aren't my buy prices. They're my, Paul, pay attention here. And I have 99 companies here and growing because I use this my way of generating my ideas and keeping track of them because it's too hard to sit there and go, oh, I have 100 companies. Let me just keep looking them up over and over. That's too tedious. So for less than $1 a day, you can get all this software at everythingmoney.com. And let me show you all the things that come with the software. You get the mobile app, 8 pillars, 30 years of financial data, stock analyzer tool, exclusive daily content from Mo and I. We make videos every day just for our community that get posted every day. And the best part is it's based on requests that you guys have that then get upvoted in the chat. You get access to us. You get a real estate calculator, which is being worked on currently, stock screeners, retirement calculator, and the Everything Money community. And guys, you can cancel at any time. There's no commitment. This is all for less than $1 a day. Our competitors are so much more, and they don't give you as much. It is a no-brainer. So go to everythingmoney.com and sign up. So Microsoft Stock Analyzer tool, boom. All right. Low price of 100, high price of 175, mid price of 133. I have it on my watch list at 170. Guys, add it to your watch list wherever you want. Start doing research, get ready, because the stock has already fallen from 350 down to 219 as a low. It will continue to fall, my guess, as all stocks fall in the future. Thank you very much for your time. Please go to everythingmoney.com and sign up. It'll be the best financial decision you have made. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?